Hello and welcome to this quarterly update for the Magellan Infrastructure Fund. My name's Felicity Haynes, Head of Wholesale for Magellan, and today I'm joined by McVicar and Ofer Karliner, who are the portfolio managers and co-heads of Magellan Infrastructure. Thanks for joining me. Obviously, the markets have been pretty volatile over this past quarter. Can you just talk us through some of the key high-level themes that you've been looking at?
Yeah, sure. So infrastructure's sort of mid-single-digit returns this quarter versus MSCI World down about 2.4%. That's largely because the demand profile and nature of infrastructure is very defensive. So what we've seen is really in the quarter, the tariffs start to get implemented across the world. China, Canada, Mexico was the first iteration of that. That creates a lot of uncertainty, not just the tariffs themselves, but the fact that they're on, they're off again, they're on, then they're like partly pulled back. That uncertainty means that it's very hard for businesses to invest. So we spoke to the CFO of a major utility in the US, and they're at the very defensive end of this, even they're delaying investment. So I said, look, we've got global supply chains. Things we would need 5 years out, we're still going to order, but the things we can get in pretty short order from Canada, we're just going to wait and see where things land. So if they're thinking that, what the manufacturer or the retailer thinking? So clearly there's a lot of uncertainty in terms of risk and in terms of the way this plays out in terms of economic growth as well. The great thing about infrastructure is, in the short term, certainly there's very little impact to the companies we look at. Even rail, which theoretically is the most exposed, we haven't seen any real decline in cross-border trade between US, Canada and Mexico in terms of volumes. Utilities are obviously very well protected. They can pass through those costs. Again, the irony of a man who can pass through his costs, saying we're waiting to see where costs land, means that they're really concerned about this. In terms of other areas, aviation really haven't seen any impact, and likewise with toll roads, it's still too early to say. In the future we'll see, but so far no big impacts.
Great. So what calls have worked and what didn't work so well in this last quarter?
So when we think about the last quarter, and as Ofer has just talked about, the portfolio in probably pretty tough investment markets has performed reasonably well in those conditions, which we generally hope to see from the types of assets we invest in. But as always, there is some winners and losers across the portfolio in such a short period of time as a quarter. So on the positive side of the ledger, there are a number of companies that performed well. A couple I might call out. One is Vinci, which we've talked about in the past as a more significant position in the portfolio. It's a high quality business. It's made up of largely French roads as well as a diversified airports platform and a contracting business, which faces a lot of different parts of the economy, but leverage more to Europe. What we saw is we had increased our exposure to that business really in the middle of last calendar year, off the back of some of the French political instability around the National Assembly. So that obviously provides a little bit more political support for Vinci, but not a significant change to the business outlook. The other thing that happened as well during that period is, some might recall, Germany also came out and announced a sort of a 500 billion euro, call it a stimulus package. That really saw, in terms of the share price reactions, anything with a contracting business perform quite strongly in that environment. And so Vinci, with a contracting arm of the business, performed well during there. So all in all, I'd say the business kind of did what we expected it to do. There was no significant changes in the outlook, but the share price response was reasonably positive there. Another company that we haven't talked about as much in the past is a company, Italgas. They're a long-standing position we've held. As you might imagine, Italgas, they're in the gas distribution business in Italy. Really high quality business, great regulation attached to it. And the thing that we think about there as much as anything is, we've liked the business because one of the things they're doing is they are focusing on acquiring, they're the largest player in the market, and they've been acquiring the second largest player in the market. Now, that took some positive steps during the quarter. You saw the antitrust approvals being received for the merger. And the nice thing about this is, and why the market likes this acquisition, and something we support of, is one is the valuation or the price they're paying looks very reasonable for the type of asset they're buying. And secondly, the thing that's really positive here is, when you combine two businesses like utilities, you tend to be able to get really good cost synergies out of those businesses. You've got contiguous service territories and there's some real opportunity there. So that should be quite positive there. Another positive performer for us was the company Aena, Spanish airport business. It's been a long-standing position for us. But one of the things that really happened during the quarter is we're starting to see comments from the company that are indications of the growth opportunity in terms of capital deployment into that business, into the next regulatory cycle, which kicks off in a few years. So that's, it's incrementally positive, but it's on the trajectory for the thesis we've got in that business. On the negative side of the ledger, in terms of contributions for the period, there's always a few. One I'd probably call out during the period was the company Sempra. Sempra, what we saw was, for background, they are a regulated utilities business based in the US, key operations in California and Texas. What we saw is they caught the market flat-footed and downgraded their earnings. Why they did it, there was a few different reasons, but the main one was they were really trying to accelerate the growth in their Texas business. And in doing so, effectively, it's one of those situations that you've got to invest more now, grow more later, which was poorly received by the market, because obviously communications for these stable assets is really key. And so we saw that as a negative reaction. For us, we continue to like the growth opportunity, but it has pushed that out a little bit further in terms of the share price response.
Thanks for that detail, Ben. And from here, the uncertainty looks like it's going to continue for some time. Can you just talk about the outlook and some of the key risks that you see going forward?
Yeah, uncertainty certainly is the word of the day at the moment. There's a lot of, it's very difficult to predict exactly what's going to happen. I talked about the direct impacts to infrastructure before. They are pretty limited in the near term. What happens in terms of indirect impact is a lot hard to predict from here. So all else equal, increasing tariffs in the US means increasing inflation. Now, the second order responses to that are, do wages go up off the back of that as well? If it's a one-off increase in inflation, the central bank will probably look through that. So the rate environment will probably go up a little bit, but not too badly. If we start to see wages push up as well, that's going to see a higher for longer scenario for rates in the US. Running counter that, and it's really, again, an increasing risk as we see it going forward, is the risk of recession. The things I spoke about before, the uncertainty in terms of business investment, and how do you invest in an environment where you don't know where your cost base is going to be. And consumer confidence is starting to really tip over as well. That means we're increasing the chance of recession as well as we look forward. Now, would fully expect Trump to stimulate the economy. No politician wants a recession. But the longer we leave it for that to happen, the more uncertainty persists in the near term, the greater the chance of recession. As infrastructure investors, they're not that impacted by recession generally. There are certainly some impacts. And utilities regulate at the point of earnings, so you're generally well protected. There may be some small impacts to CapEx profiles, but that's largely at the margin. Where you're exposed is rail. They are more linked to the economy, and therefore you can see volumes come off. If we were in a recessionary scenario, those tend to be short-lived. In previous scenarios, GFC, etc., they can tend to bounce back within a year or two. So relatively comfortable to understand that, and indeed we've taken views around that rail position as well. Airports are getting exposed a little bit to the economy by the nature of their discretionary spending. However, what we've seen over the past couple of years is people have, we've cut other areas of discretionary spending but not cutting travel. So COVID has really focused people's minds on they want to travel. They're just travelling less. In other words, travelling for shorter periods of time, travelling to cheaper destinations and staying at cheaper hotels. So as an airport, you don't care how long they stay, just they come in and they go. So certainly you probably see some impact at the margin, but the other thing that's going to help you over the next couple of years is the fact that there's a lot of aircraft capacity being put into the market over the next couple of years. That should help keep ticket prices down as well. So that should also act as a buffer there. On the toll road front, urban toll roads are very resilient. In the GFC, a lot of them actually continue to grow, or saw very small declines. That's because the nature of the trips are people travelling around their cities, not necessarily people travelling to and from work. Intercity roads are a bit more exposed. You have more truck traffic, but even then, we look at the French networks. They saw reasonable declines in truck traffic to the GFC. They continue to grow their earnings because car travel continued to grow. People were substituting flights for car trips. They had toll increases as well, and they managed to take costs out of the business to keep earnings growth stable. So, generally speaking, infrastructure is pretty well positioned for that recession and for weaker economic environments.
So given all of that, how's the portfolio positioned?
Yeah, sure. So the portfolio, the very nature of what we do, and Ofer has touched on some of this, is we're always going to have a portfolio that is, call it, more defensive than a lot of assets out there, but particularly when you compare us to, say, the global equity space, we're going to have a very defensive skew in terms of our process and philosophy in what we invest in. When we think about the portfolio as it stands today, we've had a view for a while that where we've seen opportunities probably more in the European, UK market, not to the exclusion of North America, but we've been more skewed in that direction. The investments in those markets are a mixture of different end assets. We've got things like regulated utilities. I talked before about that company Italgas. That'd be an example of one of those utilities. We've also got some regulated water exposures, as well as electric companies. And then at the same time, we've got some exposure to things like airports, toll roads, communication assets in that market. So the real point I'm trying to get across here is that we've got a decent exposure to those markets, but it's also highly diversified of what we have in those markets. And so that's obviously been positive in current market conditions. And then in terms of exposures to potential economic disruptions, we've really got one sector we see the most exposure, and this goes back to those rail companies. And that for us is something that we like in the portfolio. We see great opportunity in the long-term structural story, but you do have to manage that cyclical risk around those assets. And we've got call it mid-single digits of the portfolio there. So not a large exposure, but enough that if things start to improve, you can get some benefit out of that as well. So as I step back and look at the portfolio, we have a portfolio where we think it continues to look very defensive, but at the same time, we think there's some good opportunities in there, and we continue to look at the opportunities that markets are throwing forward to us at the moment.
Thank you. Well, thanks so much for the update today. And thank you for joining us. I hope you found this useful, and please feel free to pass on to any colleagues and clients that might find it of interest. Thank you.